EMLP. It's actually the largest active equity ETF on the market. It's a MLP-ish energy fund because it only has 25% MLPs. If you go over that, you have to have a different structure. So this way, it's a 40-act fund. That's a detail that's important to some people, but that will mean less yield. That's the trade-off. It's huge at $2.8 billion, 95 bips, a little pricey for an MLP-type fund. Let's look at the holdings. And you only got 25% MLP, so what else do you put in there? You put in pipeline companies and utilities. So you're going to see a mix of that here. Again, that's why the yield would be more like 3% versus 8% for an AMLP. Let's look at the returns of this versus AMLP and a utilities ETF, XLU. And you can see this one's going to be right in between it, right? Because it's a mix of MLPs and utilities. Here's EMLP. So, Scarlet, I think this is good for people who don't like that tax issue on some MLP funds and want the active hand.
All right, got it. Now, still with me is First Trust ETF strategist Ryan Issakainen. So, Ryan, EMLP clearly is kind of a hybrid ETF in that it has both utilities and these MLPs, master limited partnerships. How exposed is EMLP to rates versus, say, oil prices?
Yeah, well, part of the active selection of EMLP is to avoid companies that are more correlated to the fluctuation in oil prices. And so within the MLP segment, we're not selecting MLPs that have had more exposure to exploration production, but more the pipelines that are less correlated. And the same is true with the other portions of the portfolio. We don't want to have something that is negatively impacted to fluctuating oil prices. In terms of interest rates, the utilities portion, obviously in the near term, sometimes you see some correlation negative with rates. But longer term, what we found is actually the impact on utilities when rates go up is not nearly as bad as most people think.
Okay. Now, we were talking earlier, Eric, about the biggest ETF issuers in 2019. First Trust coming in 5th place.
Yeah, and you were the largest active ETF issuer. I think most people will be stunned. PIMCO's too. I want to get your thoughts. You've done it the transparent way. Now you have active non-transparents about to just flood the market. I call it the ant invasion. What do you think of that? Do you think that's going to change this over the next couple of years? Are you worried about this coming competition?
I wouldn't say that we're worried about the competition. We can always utilize some of these non-transparent forms of ETFs should we choose to at some point in the future. At this point, the strategies that we have put into place within our actively managed lineup, we're very comfortable with disclosing our portfolio on a daily basis. And that actually has a benefit to investors, right? They can know what they own. That's one of the key features of ETFs, and they can know where their returns have been generated. And they haven't really, we haven't seen a negative impact on returns, especially when we have less turnover in some of these strategies and a lot of fixed income strategies.
I'm still impressed by the fact that you're the 5th biggest issuer in 2019. You're clearly getting a lot of assets, and I think part of it is you guys seem comfortable with spending money when other firms may be cutting back. We hear stories about rented baseball stadiums. Is that your advantage? Is that the secret to sidestepping the Vanguard effect?
Yeah, I'm not sure who rented a baseball stadium, but it certainly wasn't us. One of the ways that we've chosen to invest is not through a lot of our competitors might hang a sign in left field in a baseball stadium. We would rather spend money in educating the investment professionals that use our funds because they're really the ones that are best suited to make their clients money and to make those best decisions for their clients. So that has been our focus. We want to focus on investment professionals who know how to use our funds.
Speaking of one of your funds, I've always liked this fund, TDIV. It's the Tech Dividend. It used to be an oxymoron, but now they're yielding more. Tech's got a great run. These are like conservative tech names, the old 90s type tech names, Apple in there, but still Intel, Cisco. What's the case for this in the coming decade as a play to be tech but not have high beta?
Yeah, so one of the interesting things about the technology sector is it's the most underweight sector in most equity income strategies. If you compare them to the S&P, biggest underweight is to tech. And at the same time, technology stocks pay more in dividends than any other sector in the market. And so where we see this fund being used by investment advisors most often is as sort of a bolt-on to those equity income strategies. Where you're underweight technology, here's a great way to have technology companies that pay a yield, that are more mature, and that are actually raising dividends faster than any other sector in the S&P 500.